Today, we are breaking down the 4 main types of health insurers you absolutely must know for your health insurance licensing exam. The exam will fundamentally test you on the difference between a reimbursement model and a service model. This distinction drives many of the questions you'll face. A reimbursement or indemnity plan involves the insured paying for services and then being reimbursed by the insurer. A service plan means the insurer pays the provider directly on behalf of the insured. Let's start with commercial insurers. These are the private for-profit companies that dominate the market. For your exam, think of them as the classic example of the reimbursement model. The policyholder has a contract with the insurer, not the doctor. So if you have a traditional indemnity plan from a commercial insurer, you might have to pay the full cost of a doctor's visit up front and then submit a claim form to the insurance company to get your money back. The policy indemnifies or protects you from financial loss by reimbursing you. Next are Blue Cross and Blue Shield plans. The exam loves to contrast these with commercial insurers because they are the classic example of a service model. Blue Cross and Blue Shield organizations have contractual agreements directly with doctors and hospitals. Because of this contract, they pay the provider directly for the services rendered to a subscriber. The subscriber simply pays their copay or deductible at the time of service. Remember, Blue Cross was traditionally for hospital coverage, and Blue Shield was for medical and surgical expenses, though today they are often a single combined entity. Health maintenance organizations, or HMOs, take the service model a step further into what's called managed care. For the exam, you must associate HMOs with 3 critical concepts: the gatekeeper, the limited network, and prepaid care. The gatekeeper is the member's primary care physician, or PCP. This PCP must provide a referral before a member can see a specialist. Without that referral, the HMO will not pay. Care is also restricted to a specific network of providers. A common exam trap question describes a scenario where an HMO member self-refers to a renowned specialist out of network for a non-emergency. The correct answer is that the HMO will deny the claim entirely. HMOs also operate on a prepaid basis, often paying doctors a monthly fee per member, a system known as capitation, regardless of how many services that member uses. Finally, and this is a major point of confusion on the exam, we have self-insured employer plans. When a large company decides to self-insure, it means it is setting aside its own corporate funds to pay their employees' health claims. They are acting as their own insurer. They may hire a third-party administrator, or TPA, to handle claims processing, but the employer is the one bearing the ultimate financial risk. Here is the #1 exam trap you must avoid. Self-funded plans are not regulated by state insurance laws or the State Department of Insurance. They are regulated by a federal law known as ERISA, the Employee Retirement Income Security Act. If you see a question about who has jurisdiction over a self-funded plan offered by a large corporation, the answer is the federal government, specifically the Department of Labor. To keep this straight, use this phrase: if the employer funds it with their own cash, the feds watch the stash. So when you see a question, first identify the insurer type. Is it a commercial reimbursement plan? Is it a BCBS or HMO service plan? Or is it a self-funded plan governed by ERISA? Nailing these distinctions is key to passing. For free practice questions, AI-powered explanations, and more exam prep tools, visit openexamprep.com. That's openexamprep, all one word, .com.